The United States government just added $1 trillion to the national debt in 71 days. That's $192,000 per second. And nobody's panicking. Nobody's demanding answers. Because what's happening isn't a crisis that arrives suddenly. It's a solution being implemented quietly. The debt is now $38 trillion. That's 120% of the entire American economy. Interest payments alone exceed $1 trillion annually, more than we spend on defense, more than Medicare. The math is simple and terrifying. We cannot pay this back, not through taxes, not through spending cuts, not through economic growth. The numbers don't work, and everyone who understands government finance knows it. So here's the question nobody wants to ask. If we can't pay it back, how does it go away? The answer is already being implemented. You're living through it right now. The Federal Reserve is making $38 trillion disappear, not through default, not through dramatic collapse, but through a mechanism so subtle that most people will never realize they paid for it. They're using a strategy that's been deployed twice before in American history. And both times it transferred trillions in wealth from savers to the government while maintaining the illusion that everything was fine. This is financial repression. And it's happening faster than anyone wants to admit. Between August and October 2025, the debt jumped from $37 trillion to $38 trillion. During a government shutdown, $382 billion was added in just 23 days. The acceleration is undeniable, but debt accumulation is only half the story. What matters is what happens next. Because throughout history, governments drowning in debt they cannot repay have exactly three options. Option 1 is explicit default. Stop paying. Declare bankruptcy. Watch the financial system implode. No major economy has chosen this path voluntarily because the consequences are immediate and catastrophic. Markets collapse, trade stops, the currency becomes worthless overnight. This option destroys the government that chooses it. Option 2 is austerity. Slash spending, raise taxes, pay down the debt through fiscal discipline. Greece tried this after 2010. The result was economic depression, 25% unemployment, political chaos, and a generation of lost growth. And Greece's debt was a fraction of ours relative to their economy. Austerity on the scale America would need is politically impossible. No party would survive proposing it. No electorate would accept it. That leaves option 3. Make the debt disappear by destroying the value of the currency it's denominated in. You don't pay back $38 trillion. You pay it back with $38 trillion that aren't worth what they used to be. The debt remains, but inflation erodes its real value. This is the path every major debtor nation eventually takes, and the United States is no exception. Here's how it works in practice. Imagine you owe someone $100,000. That's a crushing burden. But if inflation runs at 6% annually for 10 years, the real value of that debt gets cut in half. You still owe $100,000 nominal dollars, but in terms of purchasing power, it's now equivalent to $50,000. You've been relieved of half your debt burden without paying a cent extra. The person you owed just lost $50,000 in real wealth, transferred directly to you through currency debasement. Now scale that up. The US government owes $38 trillion. If inflation runs higher than interest rates for a sustained period, that debt shrinks in real terms. A researcher concluded that 6% inflation over just 4 years could reduce the debt to GDP ratio by 20%. That's the equivalent of erasing $7 trillion without cutting a single program or raising a single tax. The term for this process is financial repression. It's not a conspiracy theory. It's documented economic policy with a formal academic definition. Financial repression occurs when governments keep interest rates artificially low, below the rate of inflation, creating negative real returns. When you earn 2% on your savings but inflation runs at 4%, you're losing 2% annually in purchasing power. That loss doesn't vanish. It transfers to borrowers. The biggest borrower is the government. This strategy has been used before, twice. both times successfully. After World War II, the United States faced debt equal to 108% of GDP. The war had been financed through massive borrowing, and the bill had come due. Explicit default was unthinkable. Austerity would have triggered depression. So the government chose inflation. Between 1946 and 1955, the debt to GDP ratio was cut almost in half. How? The Federal Reserve kept interest rates below 1%, while inflation averaged over 4% annually. Real returns on government bonds were negative. Savers holding Treasury securities lost wealth every year in real terms. That wealth transferred directly to the government, reducing the debt burden without anyone signing a tax increase into law. By 1975, debt had fallen to 25% of GDP. The strategy worked flawlessly. The debt disappeared. And most Americans never understood they'd paid for it through the silent tax of inflation eroding their savings. The playbook exists. The precedent is clear. And right now, the conditions are being recreated. Since 2010, the federal funds rate has been below the rate of inflation more than 80% of the time. Negative real rates have become the norm, not the exception. The mechanism is already in place. But there's a problem this time. The scale is different. The debt is larger. The global financial system is more interconnected. And the Federal Reserve's independence, the thing that's supposed to prevent this exact scenario, has been quietly compromised. What exactly does compromised independence look like? It's not dramatic. There's no public announcement. The erosion happens through a series of quiet accommodations, each one seemingly reasonable in isolation, each one narrowing the Fed's options until there are no options left. The mathematics are brutal. When Paul Volcker crushed inflation in the early 1980s by raising rates to record highs, national debt was only 25% of GDP. That low level meant interest payments took time to impact the budget. The government had breathing room to adjust. Today, debt exceeds 120% of GDP. When the Fed raises rates now, the effect is instantaneous. Interest costs explode overnight. This creates an impossible trap. If inflation rises and the Fed tries to fight it by raising rates, those higher rates immediately add hundreds of billions to the deficit. That larger deficit requires more borrowing. More borrowing means more bonds to sell. More bonds flooding the market push rates even higher. Higher rates increase the deficit further. The cycle feeds on itself. At some point, the Treasury simply cannot afford to validate the Fed's inflation-fighting measures. The government must choose between controlling inflation and avoiding bankruptcy. When that choice arrives, fiscal needs override monetary policy. The Fed's independence becomes theoretical. Former Treasury Secretary Janet Yellen, who previously chaired the Federal Reserve, stated publicly that the preconditions for fiscal dominance are clearly strengthening. She's not speculating. She's describing what's already happening beneath the surface. Markets understand this dynamic perfectly. Bond traders know the Fed cannot sustain high rates indefinitely. They know the government needs low borrowing costs to survive. This knowledge shapes expectations. If investors believe the Fed will eventually cave to fiscal pressure, they'll demand higher yields today to compensate for future inflation. Those higher yields make the fiscal situation worse, forcing the Fed's hand sooner. Some economists argue we've already crossed the threshold. They point out that markets barely reacted to political pressure on the Fed because the damage was done years ago. Budget deals, tax cuts, chronic deficits, all of it steadily narrowed the Fed's real freedom to act. The formal mandate remains unchanged, but the practical ability to execute that mandate has evaporated. Here's the core problem distilled to its essence. Debt and deficits are so massive that over time, we will monetize them to some extent and accept higher inflation because we prefer that over higher taxes. Nobody says this explicitly, but the math says it anyway. Monetization means the Federal Reserve prints money to buy government debt. It's the final stage of financial repression. The central bank becomes the buyer of last resort for Treasury securities that nobody else wants at prevailing interest rates. This prevents a debt crisis. It also guarantees currency debasement. During the pandemic, the Fed's balance sheet doubled from roughly 4 trillion to 9 trillion. They purchased trillions in Treasury securities and mortgage-backed securities, creating money from nothing to fund government spending. The justification was emergency response. But notice what happened next. When inflation surged in 2022, the Fed began quantitative tightening, slowly reducing the balance sheet. By December 2025, they'd brought it down to 6.58 trillion. Then they stopped. They announced a shift to reserve management regime. Translation: the balance sheet stays at this elevated level indefinitely. Why stop there? Because going lower would drain too much liquidity from the financial system. Banks need reserves. Treasury markets need a buyer. The economy needs the Fed's support to function. They've backed themselves into permanent expansion. The balance sheet will never return to pre-pandemic levels, and the next crisis, whatever form it takes, will require expansion again. Each cycle ratchets the floor higher. Each intervention becomes permanent. This is how monetization happens in practice, not through a single dramatic decision, but through incremental expansions that never fully reverse. 10 years from now, the Fed's balance sheet will be larger than it is today. 20 years from now, larger still. Each expansion inflates the money supply further. Who pays for this? Not the government. They're the borrower. The debt shrinks in real terms, not the wealthy. They hold assets that appreciate with inflation. Real estate, stocks, commodities, all rise when currency debases. The people who pay are savers, retirees, wage earners, anyone holding currency or fixed income assets. Between 1945 and 1980, real returns to US bondholders averaged negative 0.3% annually. You lost money every year holding the safest asset in the world. European bondholders fared worse. French bonds returned negative 6.6%, Italian bonds negative 4.6%, Argentinian bonds negative 21.5% annually. Confiscatory. That's the historical precedent, and it's called a stealth tax for a reason. Most people never understand they're paying it. They see prices rising. They see their savings buying less. But they don't connect it to deliberate policy designed to transfer wealth from creditors to debtors. The political appeal is obvious. Raising taxes requires votes, explanations, accountability. Cutting spending triggers protests. Defaulting destroys credibility. But inflation just happens. It's presented as an unfortunate side effect of complex economic forces beyond anyone's control. Except it's not beyond control. It's the intended result of specific policy choices made behind closed doors. Choices to keep rates negative in real terms. Choices to expand the money supply. Choices to prioritize debt service over currency stability. Foreign creditors will share this burden. As of June 2025, foreign holders owned 9.1 trillion in US debt, 32% of the total held by the public. China and Japan are the largest foreign creditors. When inflation erodes the dollar's value, they lose wealth measured in their own currencies. This creates geopolitical tension. Nations holding dollars as reserves watch their wealth evaporate. They begin seeking alternatives. China's treasury holdings have dropped by 300 billion since 2020. Japan is selling to defend the yen. Saudi Arabia is accepting yuan for oil transactions. The BRICS nations are developing alternative payment systems that bypass the dollar entirely. This isn't theory. It's happening now. The Bank for International Settlements published a report in December 2023 titled The Future Monetary System. On page 47, buried in technical language, they state that central banks should prepare for scenarios where multiple reserve currencies operate simultaneously. That's the polite way of saying dollar dominance is ending. When that shift accelerates, America loses the extraordinary privilege of printing money and having the world hold it. We lose the ability to export our inflation to foreign creditors. That 38 trillion debt becomes an immediate domestic crisis because we can't dilute it across global reserve holdings anymore. The political calculation becomes stark. You cannot cut spending enough to matter. Social Security, Medicare, defense, and interest payments consume nearly all revenue. Cutting discretionary spending to zero wouldn't balance the budget. You cannot raise taxes enough either. Doubling income tax rates on the top 1% generates maybe $200 billion annually. That doesn't even cover the deficit growth, let alone pay down principal. Default destroys credibility permanently. No nation defaults and maintains superpower status. The bond market would evaporate. Borrowing costs would skyrocket. The only remaining option is the one they won't announce but are already implementing. Inflate the debt away. Keep real interest rates negative. Let the currency lose value gradually enough that most people don't connect cause and effect. Research shows that 6% inflation sustained over 4 years would reduce the debt to GDP ratio by 20%. That's the target zone. Not hyperinflation that causes panic. Just persistent elevated inflation that erodes debt faster than it accumulates. The mathematical path is clear. The Federal Reserve keeps rates below inflation. The government keeps spending. The debt grows nominally but shrinks in real terms. Your savings lose purchasing power at 3 to 5% annually. Over a decade, that's 30 to 50% of your wealth transferred invisibly to the government. Over 2 decades, half your purchasing power gone. This is already underway. Since 2010, the federal funds rate has been below inflation more than 80% of the time. That's not coincidence. That's policy. Real interest rates have been negative for most of the past 15 years. Savers are earning less than inflation costs them. That gap is the stealth tax, and it's accelerating. A permanent deficit increase of just 1% of GDP raises inflationary pressure equivalent to $300 to $1,250 in lost purchasing power per household. We're running deficits of 5 to 6% of GDP annually. Do the math. Every household is losing thousands in purchasing power each year to finance government spending they never voted for through a mechanism they don't understand. The preconditions for fiscal dominance are strengthening. That's not my assessment. That's Janet Yellen's warning, former Treasury Secretary, former Fed Chair. She sees what's coming. When the central bank must finance government deficits because private buyers won't, you've crossed into fiscal dominance. The Fed's independence becomes fiction. Monetary policy serves fiscal needs. Inflation becomes structural, not cyclical. We're approaching that threshold. Treasury auctions are getting harder to fill. Foreign buyers are stepping back. Domestic buyers demand higher yields. The gap gets filled by the Fed's balance sheet. Direct monetization under different names. The infrastructure is built. The swap lines are permanent. The standing repo facility operates 24/7 with unlimited capacity. The digital currency platforms are being tested. They're not preparing for theoretical risks. They're preparing for the transition they know is coming. From the current system to whatever comes next. That transition will not be smooth. It will involve currency volatility, market dislocations, geopolitical tensions as the global monetary order reshuffles. Wealth will transfer massively, from creditors to debtors, from savers to asset holders, from wage earners to those who own productive capital. The question isn't whether this happens. The math says it must. The question is timing and speed, gradual erosion over 20 years, or crisis-driven collapse over 5. Either way, the outcome is the same. The debt gets erased through currency debasement. The people holding that currency pay the price. You can see this clearly now. 38 trillion in debt, growing by $1 trillion every 100 days. Interest payments exceeding $1 trillion annually, more than defense spending. Foreign creditors reducing holdings. The Fed maintaining negative real rates. Central banks coordinating emergency infrastructure while calling it precautionary. They're telling you everything is under control while building systems designed for catastrophic failure scenarios. History provides the template. Spain inflated their currency until it was worthless. Britain inflated away their World War debt over 30 years. The United States did the same between 1946 and 1980, cutting debt from 108% of GDP to 25% through financial repression. They're using the same playbook now. The only difference is scale and speed. The debt is larger, the imbalances are greater, the timeline is compressed. What took 30 years last time might take 15 now. And the cost will be distributed the same way it always is. Savers, retirees, wage earners, the middle class holding dollars and bonds, will see their wealth evaporate. Asset holders, the wealthy, those positioned in hard assets and productive businesses, will preserve and grow wealth. This isn't prediction, it's pattern recognition. The pieces are in position. The infrastructure is operational. The policies are active. The transfer has already begun. Most people just haven't noticed yet. They will. The 38 trillion isn't going away through responsible policy or economic miracle. It's being erased through the oldest trick in the government playbook. Silent wealth transfer disguised as economic management. You're watching it happen in real time. Every month, prices climb a little higher. Every year, your savings buy a little less. The official explanation is supply chains, corporate greed, global instability. The real explanation is monetary debasement executed with precision, denied with conviction, and paid for by everyone who trusted the system to preserve value. This has happened before. It's happening now. And it will continue until the debt reaches manageable levels or the currency collapses under the weight of debasement. Either way, those holding cash and bonds lose. Those holding real assets survive. The choice isn't whether to participate in this transfer. You're already participating. The only choice is which side you're on when the rebalancing completes, because $38 trillion doesn't just disappear, it gets redistributed. And if you don't understand the mechanism, you're the one paying for it.